Hi folks, it's Vince Gaetano of the Wise Old Owl Show. This is a special edition show to cover Stats Canada's reporting of the April CPI inflation index. The report came out this morning and it wasn't good news, folks. It is moving in the wrong direction. The estimates were that the inflation rate was going to be coming in at 4.1%. It actually came in at 4.4%. Slightly above what March came in at, and primarily rent increases and mortgage costs were the main contributors to this all-item CPI increase in April of 2023's report. So the fact is, inflation is starting to become sticky. What did it result in? The bond market spiked today. The last we had this afternoon, the bond market for the 5-year Canada bond bumped up to 320, 321. So that's up significantly from last week when it hovered below 3%. So that's almost a quarter-point increase. Not sure it will spark the Bank of Canada to increase at the beginning of June when they next meet for their overnight interest rate meeting. But it does tell a tale that this could be a long road for interest rates to stay where they are before they start coming down. We may even see an increase if this becomes problematic. Some of the things that were pointed out is gasoline prices rose by 6.3% compared with March. This is the largest monthly increase since October 2022 in this category. So we are seeing some still groceries, gas, mortgage interest costs, rent, driving inflation to a level that is causing some concern. Interest costs are up 28.5% in April year over year. That is the driver. Rents are up significantly, and this is going to cause significant problems. Now, having said that, when we look at some cracks in the system, we're seeing credit card net losses go up. People's balances on credit cards going up. Defaults are increasing. We're starting to see household debt service ratios peak as interest costs take a bigger chunk of disposable household income. We're also seeing some increases on the consumer proposal side and consumer insolvencies. We're seeing these numbers spiking considerably across the country, and in Ontario and British Columbia in particular, hitting levels not seen since the early 2000s. So this is a concern, something we're going to keep an eye on. And what we will eventually see is this creep into the mortgage delinquency ratios. We're not seeing it yet because Canadians do pay their mortgages first and they'll let everything else falter. But once you see credit card delinquencies starting to creep up, you're starting to see insolvencies, bankruptcy proposals increase. You're starting to see people try to manage their unsecured credit. They're trying to get some relief in that area, and the secured debt, which is primarily mortgages, gets dealt with last because that's the first thing people pay. They want to keep the roof over their head. So really, we're going to keep an eye on what's happening in the second half of the year as the impact of these cracks are delayed considerably. So we'll keep an eye on that. Was down in the States last weekend for a wedding. Not a lot of inventory there. There's not a lot of movement, and the reason being is in the States they have 30-year term mortgages. And when you have those lengthy terms at preferred rates of 2-3%, there isn't any incentive to break them to get into higher rate mortgages. And when you're looking at 5 and 6s, why would anybody want to pay double the interest cost just to move? So there's a lot of people sitting in their homes, riding it out, paying their mortgages, and just clamping down on expenses, budgeting, and the like. Really interesting to see what is going on down there. We're in the Philly area, and I was really keen on speaking to some folks who are in the business, and the consensus is things are extremely slow in the real estate, mortgage, and insurance business. and it's impacting the economy down there. They still believe that more hikes are coming from the Fed. I don't know if we're necessarily going to see the Bank of Canada follow suit, but if these inflation numbers continue to be sticky and not move to that target 2% interest rate, we could be in for some headwinds and some bumpy rides. Good news coming out of the City of Toronto. City Council approved upzoning. And what that means is they have approved in the Yellow Belt, and that's predominantly single-family homes, can now be zoned up to 4plexes. And I do believe that includes 4plexes plus a garden or laneway suite, so potentially 5 units where permitted. This is going to be an interesting legislation change, because now will there be a flurry of people wanting to get permits to do this? Will people spend the money to convert these units into legalized units? And the key there is legalized. They have to be properly built by code, with fire code regulations taken into effect, and making sure that these are legal units. That costs money. Permitting, construction costs is still quite expensive. So we'll see what the impact of this legislation is on the output of these units. But a good sign that the city is not backing down from NIMBYism, which has always been a problem in this city for getting anything done. So really interesting stuff. It really paints an interesting picture as to how additional rental units can be built in these type of properties, and it'll be interesting to see. So I'll leave it at that. I want to thank everybody for your support over the last few years, and please subscribe and just hit the button, subscribe, and really love to have your support. And we're going to try to put out some more content beyond just the live shows that we do every week. Have a good day, and we'll talk to you soon.